With us now is Evercore ISI's Jon Chappell. He cut his price target on the stock. It had been 318. It's now 243. You still do have an outperform rating on the stock at this point, Jonathan. I guess first question is why?
Well, I think it's important to point out first that we did initiate a tactical underperformed trading call on August 23rd with the anticipation that there would likely be a miss and a lower in the fiscal first quarter results that are scheduled for next Thursday. So the catalyst was correct, the magnitude way off. Certainly not going to chase it down with a downgrade after this $45 sell-off today. I guess the jury could still be out on that, but we're keeping the tactical underperform because, frankly, the catalyst is done, but there's a lot of uncertainty still. I mean, a 50% cut to the fiscal second quarter numbers on business conditions that worsened greatly over the last several weeks and are now worsening at an even more accelerated pace through these next 3 months, which are really the peak season, of the retail season. And also just there's been some identification of cost initiatives, but no clarity on the timing or magnitude of those. We'll be looking for a lot more information from that next week with the actual earnings release. And then I think we can start to more appropriately incorporate that into the back half of the fiscal 23 and probably more importantly at this point, the fiscal 24 outlook.
Got it. Jonathan, we've been talking this morning about investors, not just investors in FedEx, but broadly speaking, investors who are trying to determine how much of this is reflective of real deterioration in the macro economy worldwide, China and Europe obviously being key parts of that as well. How much of this is really an execution issue for a company that has had its share of them for quite some time? Where do you come down on that?
Yeah, I mean, I'm not going to put a percentage on it like I think Jim was trying to do this morning, but what I'll say is there's a healthy dose of both. So let's take the macro component of it first. Europe is no doubt in a recession for the reasons that you've explained associated with Russia and energy, et cetera. And I want to point out here, Evercore ISI has a legendary economist, Ed Hyman, who's been talking about a global recession for some time now, but not a U.S. recession. So we have this deep slowdown in Europe that's probably getting worse. You have these issues in Asia, but remember the way that FedEx operates in Asia is exporting through their Air Express system. It's not necessarily representative of demand on the ground in China. It's more representative of exports there. So yes, there are slowdowns associated with zero COVID, but I think it's also a bit damning as it relates to the consumer in the West. And that ties us back to the U.S. The U.S. is not as bad as those regions, but it is not immune. We've been talking about elevated inventories since before the big major box retailers revealed them in the middle of May. We knew there was overbuying, triple buying, double buying, whatever it was last peak season, because retailers were concerned about missing another selling window after the negative muscle memory from the fourth quarter of 2020. So inventories are inflated. Inflation is hitting the consumer. The U.S. is certainly at risk here, but I don't think it's nearly as dire as it is in Europe or nearly as disruptive as it is in Asia.
What happens, John, if UPS or any of their major competitors don't ratify the view? I mean, that would be a remarkable broad-based guide that others didn't see.
Yeah, well, again, I don't think they will. So we have to talk about direction and we have to talk about magnitude. We met with UPS last week. Royal we, it was my team. But we met with UPS last week, and they basically reiterated their guidance for 2022. Now, FedEx is in quarter one of their fiscal year, and UPS only has 2 quarters left. I've spoken to all the major rails ahead of this potential rail strike this week, the biggest trucking companies in the world, the bigger truck brokers in the world. They're all talking about an element of demand caution, but nothing to this magnitude. So, back to your point, and again, not trying to put a percentage on it, there is a macro concern here, but there is a hefty dose of costs, execution, service, et cetera, that does make this far more FedEx specific than more damning to the entire transport or global economy.